Hey, welcome. So, you're running a business here in Canada, and you know the name of the game is growth, right? But how do you fund it? That's the real million-dollar question. Today, we're going to break down how to build a smart, strategic financing plan that actually works.
Does this feel a little too real? You see this perfect opportunity. Maybe it's a new piece of equipment that could seriously boost your output, or a great new retail space. But the idea of tying up all your cash, it feels like a massive gamble. It's a classic keep-you-up-at-night problem for small business owners. All right, so here's the big mindset shift. We need to stop thinking about getting just one loan and start thinking about building a financial toolbox. You wouldn't use a hammer for every single job, would you? The same idea applies here. This approach is how you grow smart without completely draining your bank account.
Okay, let's open up that toolbox and look at our first tool, the term loan. You can think of this one as your heavy hitter, the power tool you bring out for those big, planned-out projects.
A term loan is pretty straightforward. You get a big chunk of cash all at once, and then you pay it back over a set amount of time with payments that are exactly the same every single month. And that predictability? That's its superpower. It makes budgeting so much easier because you always know what's due.
So when do you reach for the term loan? Well, it's perfect for those big one-off expenses. Things like opening that second location you've been dreaming of, doing a major renovation, or finally making that big facility upgrade you know you need.
All right, on to tool number 2, the line of credit. Now, if the term loan is your tool for predictable, planned expenses, the line of credit is your all-purpose multi-tool. It's all about flexibility and helping you manage the unpredictable.
A business line of credit gives you a credit limit you can tap into, but here's the magic trick. It's revolving. That means you can draw money when you need it, pay it back, and boom! That credit is right there, waiting for you to use again, no new application needed. And best of all, you only pay interest on the money you're actually using.
This is your absolute go-to for managing the day-to-day up and down rhythm of your business. It's perfect for bridging those stressful cash flow gaps while you're waiting on invoices or for stocking up on inventory before your busy season hits. It's basically your financial safety net. So let's just put them side by side for a second. The term loan is a lump sum for big planned projects, and you pay it back with fixed payments. Low flexibility, but high predictability. The line of credit, on the other hand, is all about revolving access for those flexible, short-term needs. It's all about choosing predictability versus flexibility. Now, what if you have a very specific job to do? You need a specialized tool for that. When it comes to buying assets like machinery, vehicles, or important tech, there's equipment financing. This isn't just a generic loan, it's a custom-built solution for one specific purpose. So here's the deal with this one. It's a loan or a lease that you can only use to buy a piece of equipment. And what makes it so special is that the very equipment you're buying also acts as the security, or the collateral, for the loan. This makes it a lot less risky for the lender, which you'll see is a huge win for you.
And the advantages here are massive. Because the loan is secured by the asset itself, it leaves your cash and your other lines of credit totally free for other things. You can often get better interest rates, and you're spreading out the cost of a critical piece of gear over its entire working life. It's just smart.
And believe me, this isn't some obscure financial product. Major Canadian industries absolutely rely on it. We're talking manufacturing, construction, transportation, even healthcare and tech. If you're in any of these fields, this tool has to be on your radar. Okay, we've got our tools laid out. Now for the really important part, the strategy. See, it's not about just picking one. The smartest businesses combine these tools into something we call a financing stack. This quote from David Felzer over at JP Morgan just nails it. Think about it. If you use your super flexible line of credit, your revolver, on one giant equipment purchase, you've basically handcuffed yourself. Your ability to handle day-to-day cash needs is gone. But if you use the right tool for the job, your other tools are still sharp and ready to go.
So, this is how you build that stack. You start with a solid foundation. You use that specialized equipment financing for your big-ticket assets. Then on top of that, you layer your line of credit for that crucial flexibility. And for all the day-to-day stuff, you've got your working capital. See how each layer supports the others?
And the result of all this? You protect your cash flow. You have incredible flexibility. You actually strengthen your ability to borrow more in the future because lenders see a business that knows how to manage its money. It means when a great opportunity comes along, you're ready to jump on it.
Okay, feeling ready to build your own stack? Awesome. Let's get practical for a minute. Any lender on the planet is going to want to see some paperwork. Knowing what they need before you even call them will make this whole process way smoother.
First up, they just need to know who you are. This is the basic stuff. A credit application, your government ID, a void check so they know where to set up payments, and, if you're a corporation, your articles of incorporation. Simple, but you gotta have it.
Next, they need to see that your business is healthy enough to handle the payments. That means recent business bank statements are a must. For larger deals, they'll probably want to see your financials from the last couple of years to really understand the bigger picture.
And finally, if it's equipment financing you're after, they'll need all the details on the asset itself. A detailed invoice or quote from the seller is non-negotiable. And before they hand over the money, they'll need proof of insurance that lists them as the lost payee. It's just to protect their investment and yours.
And here's one final piece of advice I want to leave you with. It is so tempting to try and time the market, to wait for that perfect moment to get the absolute lowest interest rate. But honestly, that's a fool's game. Lenders have already priced all that stuff into their rates. The right time to buy an asset is when your business needs it to grow. It's a strategic move, not a speculative one.
So, what's the big takeaway here? It's that a strategic, layered approach to financing isn't really about getting money. It's about building a strong, flexible financial foundation that lets your business grow with confidence and sustainability for years to come.
And that brings us to one last question for you to think about. Take a hard look at your own business. Is your financing right now just a random collection of debts? Or is it a thoughtfully constructed toolbox, a real strategic plan for growth?